Good morning. I just want to check on the people whose videos I can see that you can hear me okay.
I can hear you.
Okay. Well, good morning, everyone. My name is Stephen Baker. I'm the Director of Trust and Estate Services at the Innovative CPA Group. I've been a CPA for about 30 years, and I'm also a certified specialist in estate planning and probate. And I was a lawyer for about 2 decades in this area. Today, we're going to be discussing the basics of trust accounting and administration. And this is geared more towards professionals, accounting professionals, and people who advise trustees in that capacity. And you'll get an overview of fiduciary accounting and the income taxation that's related to it and how these considerations should inform the advice that you provide clients on distributions to beneficiaries. Now, whether you're a seasoned professional or just beginning to explore these areas, I'm hoping this webinar will be a valuable resource to you. We'll have a few minutes at the end of the presentation, about an hour, where I'll answer any questions you may have. So please feel free to stick around for that. Now, the first part of this we're going to cover is fundamental fiduciary accounting principles. And before we begin, I want to make sure we're on the same page with respect to terminology and the overriding considerations to everything else we're discussing today. And that starts with what exactly is a trust. A trust is a legal relationship. It's not an entity like a corporation or limited partnership. It's a legal relationship where you have a trustor or a settlor or a grantor, those terms are used interchangeably, who transfers ownership of property in a manner that divides the property rights between beneficiaries who are entitled, as their name suggests, to the benefits of the property, and the trustee who holds legal title to the property and manages the property for the beneficiaries, but also has fiduciary duties to those beneficiaries. Now, a trustor can also be a trustee and can also be a beneficiary of the trust they created. A trustee can also be a beneficiary, but the one restriction is that the only trustee of the trust, if you have one trustee, they can't be the only beneficiary of the trust. If that were to ever occur, then you don't have a trust anymore. Now, the laws vary from jurisdiction to jurisdiction, including the laws of fiduciary accounting that we're talking about today. But the applicable law for purposes of this seminar is usually in the state, or if you're dealing with a foreign trust, the country where the trustee was located at the time the trust was funded. Or if the trustee has moved to another jurisdiction, in questions of administration, your applicable law is going to be where that trustee is located. Okay. Now, what is an estate? Estate is also a legal relationship, but in this case, it's usually supervised by a probate court, and it involves the title of property in a deceased person's name, or property that passes to a deceased person's estate. For example, life insurance that they name the estate of their beneficiary, is administered by a personal representative or an executor or an administrator who pays the legal debts and claims against the estate, including taxes, and then distributes the remaining assets to beneficiaries, who are sometimes called devisees or heirs. Now, the term administrator and heirs are what is used when you don't have a will. When you don't have a will, the statute of the state where the decedent was a resident tells you where the assets of the estate go. It's called intestate administration. But the idea is the same. That administrator is sort of the equivalent of a trustee, and the heirs are sort of the equivalent of beneficiaries of a trust. The only difference is when you don't have a will is the state statute essentially provides who gets the property rather than the terms of a will. Now, note that the will of that decedent can also leave all or a portion of the estate to the trustee of a trust, and the provisions of the trust will be in that will. And this is called a testamentary trust. But keep in mind that a testamentary trust is a separate fiduciary relationship from that of an estate. Okay. And the testamentary trust doesn't come into existence at death. It comes into existence when the executor actually changes title to assets in the name of that trust. Now, another thing I want to, before we get into the detailed rules, is I want to emphasize that this fiduciary accounting, which is essentially accounting for what is, quote, income and what is, quote, principal, is required when the trust or the will provisions for distributions to beneficiaries actually distinguish between income and principal in a meaningful way. And I've got 3 short examples of distribution language that you may see in a trust. And we're going to be using these examples a couple of times in this webinar because I think they're similar to about 90% of the trusts that you will see out there. But at the outset, I wanted to talk about when you need to care about fiduciary accounting at all. Now, example A says, here you have a trust that says trustee shall distribute all of the income to the trustor's spouse annually, and upon her death, the principal shall be distributed to the surviving descendants of the trustor. Now, in this case, determining the difference between income and principal is really important. It's going to determine what the trustor spouse gets and what the surviving descendants are going to get. But to have that language in an irrevocable trust is actually not mostly what you're going to encounter. Consider example B. The trustee shall distribute all of the income to the trustor spouse annually. The trustee may also distribute such amounts from principal as the trustee determines to be necessary or appropriate to provide for the health, education, maintenance, and support of the trustor's spouse. Upon her death, the remaining principal shall be distributed to the surviving descendants of the trustor. Now, one thing I want to point out here is the trustee has discretion here to determine what's necessary or appropriate for health, education, maintenance, and support, but the trustee doesn't have carte blanche. In other words, if the trustee refuses, for example, to pay for the spouse's mortgage, the spouse could probably sue the trustee and make the trustee pay that because obviously that's for maintenance and support. So in keeping that in mind, in this case, the determination of income is important only to the extent that the income would actually be greater than the spouse's annual needs that she has for health, education, maintenance, and support. Put it another way, to the extent that her annual needs will likely exceed whatever income measure you can come up with, the issue of fiduciary accounting becomes less a matter of income and principal and more a matter of how the trustee is exercising that discretion. So again, in example B, fiduciary accounting may or may not be an important exercise to engage in. Now, example C, which is common for a lot of large gifting trusts during people's lifetime, says the trustee may distribute such amounts of income or principal as the trustee determines to be in best interest of the trustor's spouse. Undistributed income shall be added to principal at the end of each year. Upon her death, the remaining assets shall be distributed to the surviving descendants of the spouse. In this case, the determination of what is income and principal, these fiduciary accounting rules we're going to discuss over the next few slides, have practically no effect, because the computation of fiduciary accounting income is overridden essentially by the trustee's discretion, which is quite broad here. In other words, the trustee is free to distribute whatever the trustee calls income and principal, as long as it's in the best interests of the trustor's spouse. So it kind of doesn't matter in that case what gets labeled income or principal. Okay. Now, one other thing I want to note is with respect to example C, sometimes you'll see language that says the trustee may, in his sole and uncontrolled and absolute discretion, with no court ever being able to challenge what the trustee does. You'll see that language. That language is unenforceable in all 50 states. For some reason, especially over the last 10 years, a lot of estate planning attorneys, I think that they're throwing up hoops. And in every state, even with broad discretion like this, the trustee can be made to account to the beneficiary, and the beneficiary can sue the trustee in court if the trustee has abused their discretion. So no matter how broad that language is and makes it sound like the trustees can never be questioned, they can be questioned. And that's something very important to keep in mind. It's just that in this case, their standard is going to be, did they exercise good faith? And that seems like a really low standard, right? But let me give you two examples of trustees that were successfully sued, cases that I'm directly aware of where they didn't exercise good faith, because these may be situations your clients may be in. One is the beneficiary in the case of like an example C language, emails and calls the trustee to ask for a distribution. And the trustee doesn't call the beneficiary back or respond to any emails. That is not good faith. Ignoring the beneficiary is not good faith, exercise of their discretion. Saying no in an email would probably be fine. But if you ignore the beneficiary, you're not acting in good faith. The other one is where, and this is roughly the real example in a real case, is with language like example C, the beneficiary emails the trustee, who is the father's in the decedent's business partner, and says, I'd like a distribution to take a trip to Paris. And the trustee emails him back and says, you know, your father never really liked you, and I don't like you either, so don't bother asking for any distributions. This is a real thing that a client did, because they saw this language that said a court can never challenge my authority, yada, yada. Well, that didn't work out so well for him. So personal spite is not good faith, okay? So there are limitations, even when the discretion is really broad, like in example C, there are guardrails to it, no matter how broad that language sounds. Now, accounting for income and principal, fiduciary accounting is akin to a strict cash basis form of accounting, where each receipt and disbursement of cash or other property is being allocated either to income or to principal. Now, there are circumstances, we'll talk about them in a few slides, where what would normally be classified as income might be reclassified. The statute sometimes uses transferred to principal. but there are no such thing as accruals or anything like that. And one other thing I wanted to point out is if the trust receives a Schedule K1 from a partnership or an S corporation, the amount of income and principal receipts from that Schedule K1 is the amount of distributions. You'll see it in the K1 for the 1065 on line 19. For the 1120S, it's on 16. That is the amount of receipts, not the items of income and deduction that are taxable items on the rest of the K1. The income or principal, however you're going to classify it, from that partnership for the tax year is on that one line, the distributions received. Okay. The second thing is receipts of property other than cash. In most fiduciary accounting rules and regulations have to be reported at the fair market value on the date the property is received. Now, for an estate, it's relatively easy in the sense that if you're doing some sort of estate tax return, for example, for Connecticut, you have that starting point, that fair market value. But don't confuse it with the income tax principles, such as when you fund a partnership. It's not the basis in the hands of whoever gifted the asset. It's the fair market value. Okay. Now, in a fiduciary accounting, the net income can never be negative in a reporting period. That's very important. That income number, if you're doing a calendar year, for example, can never be negative. If all of the disbursements that are allocated to income exceed the receipts allocated to income, that net loss gets put to principal. Okay. Very important. That said, if that happens in a given calendar year and the next year there are net income receipts that exceed the disbursements, the trustee might exercise their discretion to be fair and adjust those receipts back to principal to compensate the principal for that net loss. Okay. But again, you have to have receipts in order to have increases in income and principal, and you have to have disbursements to have net decreases in income and principal. Okay. Now, that being said, let's discuss the detailed rules for how you characterize receipts and disbursements as income or principal under state law. Now, every state has a statute that varies slightly, but for purposes of this webinar, I'm going to be using the Uniform Principal and Income Act of 2000, which I'll call the UPIA, because it's currently the basis for statutes in 40 out of the 50 states. And 95% of the rules we're going to talk about probably exist in the state that you practice in. So rule number one, and again, these rules are in sequence. I'm going to have rule number one, rule number two, rule number three. In other words, you start with rule number one. To the extent rule number one doesn't apply, you go into rule number two, and so on. So this first rule is if the trust or terms of the will actually say you will characterize this item, for example, net capital gains, to income, then that net capital gain is going to be income no matter what this statute says. Okay, so the trustee gets to write their own rules if they want to in terms of fiduciary accounting. Now, I can tell you as an estate plan, this is relatively rare. The most common one you see is we're going to treat net capital gains as income, but that's still pretty rare to actually see in a trust. But I do want to, this is going to be a recurring theme as we go through this. I want to emphasize the importance that if you're preparing a tax return for a trust, or you're advising a trustee as to these issues, you must have the actual trust agreement every time. Because as you're seeing right here, these first two rules depend on what the trust agreement says. Okay? much less what we talked about earlier in that the terms for distributions ultimately dictate how important fiduciary accounting really is. Now, that said, the Treasury regulations impose what I would call a meatloaf rule. That is, you can do anything in your trust instrument, but you can't do that. And now, to put it differently, that trust instrument or the trustee can't depart fundamentally from traditional principles of income and principal. In other words, when it comes to fiduciary accounting for income tax purposes, there are certain things you can't do. And one of them is you can't classify ordinary dividends and interest as income. If you attempt to do that in the trust instrument, IRS just isn't going to recognize that for income tax purposes. Okay, rule number 2 is, to the extent that you don't have a specific characterization rule in that trust instrument, then the characterization of receipts and disbursements is to be made according to the exercise of a discretionary power of administration given to the fiduciary by the terms of the trust or the will. This is actually quite common. You'll see language that says the trustee shall have discretion to allocate receipts and disbursements to income and principal as the trustee finds reasonable. Okay. Now, if you're looking with respect to rule 1 and 2, one tip that I make is if you have a copy of the trust agreement in a PDF form and you're saying, gosh, this trust agreement is 45 pages, where do I find this language? What I recommend doing that's really efficient is you run an OCR scan on that PDF and you search for all instances of the terms income, principal, corpus, receipt, gain, account, and income tax. 99% of the time, you're going to find the terms, all the terms that we're talking about in this webinar. It's going to point you right to those terms if you do that search. Now, see the term corpus there? Corpus is a more archaic word for principal. In fact, in the income tax part of the Internal Revenue Code, it still refers to principal as corpus, but it's the same thing. Now, with discretionary power also comes a fiduciary duty to act with impartiality based on what is fair and reasonable to all the beneficiaries, except to the extent that the terms clearly manifest an intention that one or more beneficiaries should be favored. The way that would look is, say you had an example B, the trustor spouse is entitled to all the income plus principal for health, education, maintenance, and support. They may put a sentence at the end of that thing going, and the trustee shall consider the trustor spouse to be the primary beneficiary of this trust. All other interests of the beneficiaries shall be considered secondary, something like that. In that sense, if that's in the trust, then yes, the trustee can put the thumb on the scale for the benefit of the trustor spouse, if you have that language. But let's say you don't have that language. Part of having this discretion also means uncertainty. If the client comes to you and says, I don't know whether to make a distribution for maintenance and support in this situation, considering that the spouse has $100,000 of other income, what should I do? I have this discretion in the trust. How should I exercise it? And the cynical fiduciary litigator in me would say, it's however a court thinks you should. It can be a very subjective standard. And of course, subjectivity breeds uncertainty. So what the UPIA says, as a safe harbor, if you will, is if the trustee exercises discretion according to the characterization rules that the UPIA has, which is the next slide, then it's presumed to be fair and reasonable for all beneficiaries. So let me underline the importance of this. If you're preparing a tax return, you're obviously not going to have a question about every single item and what the trustee wants to do in terms of their discretion. My advice to you is to say it is if the trustee has been deviating from the classification rules in this UPIA in any way, you probably want to deviate in the same way. Allocating net capital gains to income would be an example of that. Absent that, I would follow the rules in the UPIA because they're the default rules. Now, if there's some material thing that seems off or unfair to a beneficiary, or particularly onerous to one beneficiary, not another, and tax burdens would be one of those, you should bring it up with the trustee. But remember, representing the trustee is not the same as being the trustee. In other words, as the accountant, you shouldn't be exercising discretion. The trustee needs to exercise the discretion. But if you have no reason to see that the beneficiary would be deviating from the UPIA characterization rules, when you're preparing a tax return or the like, I would go ahead and use those rules. Okay. And that brings me to the actual rules. If the trustee is not exercising discretion, and if the trust terms don't have a specific characterization rule, then you use the rules in the UPIA. So the UPIA will tell you when certain receipts and disbursements, what they're considered, income or principal. The next slide, we're gonna get into that. Now, there's two caveats to that. The trustee has general discretion to adjust between income and principal to the extent the trustee considers necessary. And what this gets down to is, and this is an example in the comments of the UPIA, let's say you have an investment advisor who's telling the trustee, we could maximize the size of this trust by investing primarily in growth assets. Well, growth assets don't produce dividends, and dividends are income. Capital gains, on the other hand, are principal. So in order to maximize the value of the trust as a whole, the trustee could go with the growth only portfolio, but they could make an adjustment according to this provision where some portion of the net capital gains is being allocated to income to make it fair to the income beneficiary. That would be an example of that. Okay. Now, there are certain special circumstances in the statute where the trustee is required to make transfers between income and principal or has discretion to make transfers. These are very narrow situations. For example, one of the only two required adjustments has to do with depletion on timber property. If you ever have timber property in a trust, be sure to go check the specific rules. But another one that is way more common that we'll discuss later is depreciation of a fixed asset. And that's a very specific circumstance where the statute says the trustee could make a transfer, even if it's inconsistent with the general characterization rules. Now, to the extent that you can't have a receipt or disbursement and it's not covered by one of these specific rules, the UPIA says put it to principal. Principal is the ultimate if it doesn't meet any description. Okay. Now, as for the detailed rules, this is a nice summary of how the UPIA characterizes receipts. Okay. Ordinary non-liquidating cash dividends are income. All other receipts from a business entity are principal. Capital gains distributions from a mutual fund are principal. Rents received from trust property are income. Interest on debt obligations owed to the trust is income, and a market discount on any obligation that the trustee holds for less than a year. What I mean by that is if the trustee buys a bond for $90 on June 1st and it's redeemed on December 31st for $100, that $10 is income, but that's only if they held the debt security for less than a year. And that's going to be relatively rare. All other payments on obligations owed to the trust are principal. Okay, so principal on a debt is principal for trust purposes. Insurance or other proceeds for loss of occupancy or business profits or income is all income. All other insurance proceeds, including life insurance that's paid to the trust, are principal. Okay. Now, one little thing I note here is if you have a brokerage or some other arrangement with the issuer that your dividends are going to be reinvested by purchasing additional shares of stock, that is not a cash distribution from the entity. So that is principal. Those additional shares are going to be principal. And moreover, if the trustee makes that decision, the statute's going to look at that as the trustee having elected to adjust, to reclassify something that would normally be income as principal. So just kind of be cognizant of that. Now, in terms of disbursements, regular compensation of the trustee, investment advisors, and custodians, and expenditures for accountings, judicial proceedings, and other matters that affect both income and principal are split equally between income and principal. Okay. So the investment management fee you see on the brokerage statement, half to income, half to principal. Expenditures for proceedings or other matters that primarily concern the income interest are allocated to income. And expenditures, proceedings, and matters that primarily concern principal interest are allocated to principal. Where an example of this, it's going to be rare, is that let's say you have a will or a trust that says, my commercial building in New Hampshire, all of the income is to be accumulated and it's to be distributed to my children after my spouse dies. In other words, the spouse doesn't get anything from that office building. If you had some lawsuit with a tenant about that office building, that's an item that would be allocated all to principal because it's just a principal asset. Do you see what I'm saying? Now, regular premiums on insurance covering the loss of trust property or the loss of income are allocated to income. This might seem counterintuitive. So, for example, your typical insurance on a building is actually charged to income. Okay. All other insurance premiums are allocated to principal. And then finally, payments of principal on debt, state and transfer taxes, and disbursements related to environmental matters are all allocated to principal. All other expenses of administration, management, or preservation of trust property, so this would include interest paid on a debt or expenditures for repairs or property taxes, are all allocated to income. Okay. And by the way, you're all going to get a copy of these slides at the end of the presentation. So if you need it as reference. Now, income taxes. How you account for income taxes paid by the trust. The general rule, in the absence of the exercise of a discretion granted in the next rule, any tax paid by the trustee based on receipts allocated to income are allocated to income, and any tax attributable to receipts of principal are allocated to principal. The typical way is all your ordinary income tax gets allocated to income. Your tax on capital gains would be allocated to principal. Now, The next question preparer often asks for me is, okay, how do I do that? Is it ratably? Is it marginally? And the answer is there is no answer. Again, fair and reasonable is your standard here. Now, there is a discretionary power for the trustee to make adjustments between income and principal to offset the shifting economic interests or tax benefits between income beneficiaries and remainder beneficiaries. And they can make an adjustment for any tax elections that the trustee makes, that where you're going to have a winner and a loser in terms of beneficiaries. Any income tax that's imposed on trustee or beneficiary as a result of a distribution. What that means is, we'll get to this in a minute, but the trustee gets a distribution deduction for distributing income to the beneficiary. Now the beneficiary has to pay income tax on that trust's income that gets allocated to them. What this adjustment means is that if you go back to example B and say the spouse needs $20,000 to cover her mortgage for the year, and she makes that request. If I know it's all going to be taxable to her as interest or ordinary dividend income that's flowing out to her, I can gross up the distribution so that the after-tax amount is $20,000. Does that make sense? That's what that adjustment means. Now, the big one is ownership of pass-through business entities. The taxable income must be recognized by the trust or the beneficiary regardless of whether distributions are made to the entity. Let's go back. Remember what I said about the income or principal from a pass-through entity is the distributions that the entity received. And yet you have all these items of phantom income on the Schedule K1. Well, the trust has to pay that. But when receipts are later received by the trust, the trustee could make an allocation, a reallocation between income and principal to account for who would have had to pay the tax if there had been a distribution of those income items back when the trust had to recognize them, basically. Again, question, how do you do that? Answer, that's up to you. You have to come up with that spreadsheet. Again, you're under the fair and reasonable standard. Okay. Now, quick illustration. I'm going to go through this real fast. On January 1st, this has to do with depreciation. This would be one of those adjustments between receipts and disbursements for income and principal that the statute is referring to. Let's say that on January 1st of year one, trust acquires a $1 million office building that they'll continue to lease to the current tenants, and it's the only asset of the trust. And the trust has one lifetime beneficiary, and the remainder passes to another beneficiary at death. So the determination of income and principal matters. Now, say in year one, the trustee received net cash receipts of $50,000 from the property. That's rent less the cash expenses. In preparing the fiduciary income tax return for year one, the tax accountant calculated straight line deduction for depreciation in the amount of $25,000. Now, the trust instrument doesn't address any characterization on these matters. How is that depreciation accounted for on a fiduciary accounting basis? Now, the general rule is it's not. It's not. The net cash receipts are income. Remember, rents received are income. Normal expenses for repairs and the like, those disbursements come from income. But under the UPIA, to reflect a reduction in value due to wear, tear, decay, corrosion, or gradual obsolescence of a fixed asset, the trustee may transfer to principal a reasonable amount of net cash receipts that is subject to depreciation. So if you look at the thing, what's happening here is the trustee could say, I'm going to reduce the income proceeds by $25,000 and reallocate it to principal. And the thinking here is the income beneficiary in using this asset to generate income for a year has caused a reduction or loss in value to the principal, and we're just going to compensate the principal beneficiaries for that loss of value. Does that make sense? Now, no, there's no adjustment to any asset account for accumulated depreciation. This is just a transfer of income to principal in a given year. And as a result, the income beneficiary is going to get $25,000 less income that year. And again, that's a discretionary thing that the trustee could do under the statute. Now, let's fast forward because this isn't mentioned in the statute, but I think that it's important. The trustee continues to exercise their discretion and transfers $25,000 in net receipts every year to account for depreciation. And then you get to January 1st, year 11, and the trustee then sells the building for $1.5 million. Okay. Now that's a big gain. What happens is, in the general rule, the trustee would reflect net principal receipts of $500,000. In other words, they would show $1.5 million in cash principal, and they would subtract the $1 million disbursement of the building as a principal asset of the trust. So the net principal receipts are $500,000. But again, you have this general discretion in the PIA to make adjustments that your trustee considers necessary. In this case, I would say that you need to make an adjustment back to the income beneficiary, because if you were taking off income to the income beneficiary to account for literally the loss in value being caused by the income beneficiary using the property, but you actually earned a big gain, i.e. there was never a loss in value, I think you have to transfer all that accumulated depreciation back over to the income beneficiary because there never was a loss to begin with. So you've got to kind of use your economic common sense, okay? If you're going to exercise discretion for things like depreciation. Now, income tax implications of fiduciary accounting and distributions. This is your basic way. These are the basic rules for how, on a federal level, a trust and its beneficiaries are taxed on trust income. You have to start with the idea that the trust is either simple or it's complex, because that dictates those rules. Now, simple trust is a trust where, one, all the income has to be distributed currently, and no distributions of principal are made to that beneficiary during the year. So income is required to be distributed, and that's all that was distributed to that beneficiary. If that's the case, in that year, it's a simple trust. And what happens is the amount that the trustee can deduct, the amount of taxable and tax-exempt items that the trust can deduct and send over to a Schedule K-1 on the beneficiary is equal to the lesser of distributable net income or fiduciary accounting income. So here, the determination of fiduciary accounting income is relevant to the tax effects, okay? Now note that it doesn't matter what actually got distributed, because the income beneficiary is legally entitled to the income regardless of whether it's distributed or not. That formula treats the income as though it was distributed to the beneficiary. Okay? Now, a complex trust is every trust that doesn't meet the requirements of a simple trust. And in that case, what passes out to the beneficiary on a K-1 is the lesser of distributable net income, or the amount required or actually distributed to the beneficiary. So that is based on distributions, what actually ends up on the K1 in the case of a complex trust. Okay, now what is distributable net income? Distributable net income generally is, and there are a lot of esoteric adjustments you can make to it that are in the statute, but generally speaking, what it is it's all of your taxable income and deductions and all the tax exempt income and the deductions allocated to tax exempt income. Okay. That's just a way of saying that if say you have a simple trust and your net dividends were on page 1 of the 1041, net of deductions were $10,000, but your fiduciary accounting income was $15,000. Maybe you have some items that are not, you made some adjustments from principal to income or something. That beneficiary is limited to only having to recognize $10,000 on their K1. That's really what that gets down to. Okay, well, let's talk about these original examples in terms of what's simple and complex. Going back to example A, the trustee shall distribute all of the income to the trustor's spouse annually upon her death. Principal shall be distributed to the surviving descendants of the trustor. This is always a simple trust while the trustor's spouse is alive, because all the income has to be distributed to the current beneficiary, and no principal may ever be distributed. So you never violate the second part of the definition, okay? It's always going to be a simple trust. Example B, trustee shall distribute all income to the trustor or spouse annually. The trustee may also distribute additional amounts for health, education, maintenance, and support in principal. Here, the classification depends on whether any principal was distributed to the beneficiary during the tax year. Because you won't have a simple trust, you won't meet the second prong of the simple trust definition in that tax year if any principal was distributed to the beneficiary. So that one depends on what happened in the tax year. In example C, the trustee may distribute such amounts of income principal as trustee determines to be in the best interest of the trustor or spouse. That is always going to be a complex trust while the trustor spouse is alive, because remember the first requirement of a simple trust, income must be distributed. Here, income is not required to be distributed. It's entirely up to the trustee's discretion. Okay. So, since fiduciary accounting income is not a limitation on the amount of distributable net income that passes out to be taxed to the current beneficiary, is fiduciary accounting for income and principal even relevant in the context of a complex trust? And the answer is yes, because net capital gains under the statute are excluded from distributable net income. In other words, they're not passed out to the K1 unless capital gains are allocated to fiduciary accounting income and they're actually paid or required to be paid to the beneficiary during the tax years. Okay. So since net capital gains would be characterized as principal under the UPIA default rules, either the trust instrument has to expressly characterize net capital gains as income, or the trustee has to exercise discretion to change the character from principal to income with respect to net capital gains. They actually have to make that decision, or you can't pass out net capital gains on the K1. So the big question here is, under what circumstances will an allocation of capital gains to income be respected for federal income tax purposes? And the 643B regulations provide that the trust instrument may specifically allocate capital gains to income, or if granted under the terms of the trust or applicable law, the trustee may exercise discretion to allocate capital gains to income as long as it is reasonable and impartial. Now, what does that mean? My experience in trust audits tells me that your trustee needs to act consistent. And what I mean by consistent is two aspects. You can't change your mind from year to year. That's very important. If you're allocating into net capital gains to income one year, you can't go back to not doing it the next year and then go back to doing it the next year. That's going to get you in trouble in an audit. The other thing is, you can't let's say you have two income beneficiaries, right? You can't allocate all the net capital gains to one beneficiary. If you do that, again, you're going to have problems under this regulation. So you need to be consistent. Okay. And that provides a rather convenient segue into the last part of this webinar, which is advising clients on fiduciary accounting and distribution decisions. Let me just say this right at the outset. You are advising the trustee. You are not the trustee. If a deviation from those UPI characterization rules, or from rules that are actually written in the terms of the trust, if you actually have that, any deviation from that that's material needs to be discussed with the trustee. Okay? Because you are not the trustee. It's the trustee who has to make that decision. You can advise the trustee. But again, so if you have a material deviation from the normal rules, you want to discuss that with the trustee. Again, the biggest example is net capital gains. And every tax season, it seems I have a discussion with a trustee of a new trust saying, hey, do you want to allocate net capital gains to income? Because you can do that under the trust. You're just going to have to continue to do it every year. This year, it would make a difference of X. And then the trustee emails you back and goes, let's do it. Okay. That's what you want to have in the file. Okay. Let's do an illustration along those very lines. Under the terms of the trust, the trustee, who also happens to be the trustor's spouse, is granted broad discretion in the trust instrument to allocate all receipts between income and principal. In 2023, the first year of the existence of the trust has ordinary taxable income of $50,000 and a long-term net capital gain of $100,000. And the trustee has distributed $50,000 to the current beneficiary. Now, because the current beneficiary, also the trustor's spouse, has a long-term capital loss carryover of $200,000 on her own 1040, she has proposed that the trustee exercise that discretion to treat net capital gains as income to save the trust income tax. And this would be effectively, because the rates are so compressed for trusts and estates, including the application of the net investment income tax, this would save the trust $23,800. And if she gets the net capital gain on her K1, it just eats up a part of her capital loss. Seems like a good idea, right? Well, as an initial matter, because the fiduciary accounting decisions are relevant only in so much that the terms for distribution make a distinction between income and principal, in this case, the answer first depends on what the terms of the governing instrument say about distributions. Again, gotta have the trust agreement, all right? Let's look back at our examples, okay? What if the trust says, trustee shall distribute all the income to the trust or a spouse, and upon her death, principal goes to the surviving descendants? In this case, before she makes that decision, she needs to first consider the implications in terms of any fiduciary duty of impartiality, because notwithstanding the tax savings, the additional $100,000 would be distributed to her if she exercised the discretion. So again, although the trust is saving $23,800 in taxes, it's losing $100,000 that would go to the principal beneficiaries. And so here's the first thing I want to point out. The tax tail should not wag the fiduciary duty dog. On a net basis, if she exercises that discretion here, the principal beneficiaries are losing $66,200. Okay, so don't necessarily keep the blinders on in terms of tax planning here. Here, those remainder beneficiaries might have a problem with this. Okay, because they're losing as a result of what is essentially an accounting and tax decision. Okay, now in example B, if the distributed provision said distribute all the income and may distribute for health, education, maintenance, and support, you have the same answer as in example A, but if the economics of the situation are that the support distribution is going to the beneficiary anyway, exceed whatever measure of income you're going to have, there's not really a fiduciary duty issue, okay? Because what is income in principle is overridden by the fact that her needs for support exceed that, okay? So she's going to get the distributions anyway. In any case, because the net capital gain must actually be distributed to be included in D&I, remember that the additional $100,000 distribution would have to be made within the first 65 days of 2024, and the trustee would have to make the 663B election on the 2023 tax return. Okay, that allows you to treat distributions made at the beginning of the next year as distributions made last year, because remember, in the original example, only $50,000 had been distributed and there was $50,000 of ordinary income. So you'd have to make that distribution within that first 65 days because this is a complex trust, as we just said. Now, consider the wholly discretionary trust, example C. Here, the fiduciary accounting is moot in a fiduciary duty sense, okay? And apologize here for the typo. It should be as in example B. The additional $100,000 distribution would again have to be made in the first 65 days of 2024 because again, I can't allocate net capital gains to principal to income. I mean, I can't pass it out as D&I to the beneficiary, I should say, unless it's allocated to income in a fiduciary accounting sense, and it is actually distributed to the beneficiary. Now, here's an additional query. Suppose the trustee was somebody other than the trustor or spouse, and the trustee had already distributed over $150,000 to the beneficiary in 2023. Would exercising discretion to treat the net capital gain as income actually be in the best interests of the beneficiary? I mean, think about it, because in that case, the beneficiary is losing $100,000 of the capital loss carryover. Just something to think about, okay? So bottom line is terms of the trust always matter, right? Should always be the starting point in these decisions. And again, like I said, don't let the tax planning tail wag the fiduciary duty dog, all right? And I think we're up to an hour now, so I'll take any questions that you might have.
Christina, your hand was up first.
Thank you, and thank you, Stephen, for doing this. My question is, so if I'm preparing a return and can see that the income was required to be paid to a beneficiary, but the trustee has not been paying the income, what do I do?
So and on its face, it's a fiduciary duty question because the trustee could be sued by the income beneficiary for doing that. Now, if the trustee and the income beneficiary are both, say, the trustor or spouse, that would be kind of hard to bring a suit. But even in that circumstance, don't assume it won't be an issue down the line, because strangely enough, if the trustor spouse was doing this for a long time and then died, the beneficiaries of the trustor's estate could still sue the new trustee to recover all of that income. Okay. You're not a lawyer. You're not qualified to tell clients what to do or what not to do. But in this case, if you have that language, like example A, that you're required to distribute income and you're calculating that every year and you know the income's not being distributed, you want to remind the client that they should be doing that. And by the way, there's a tax implication to this as well. So there are rulings out there that say that if you're an income beneficiary, say it's the trustor's spouse and the descendants are the remainder beneficiaries. And let's say trustor spouse is the trustee and the income beneficiary, very common scenario. And she's not distributing income to herself. She lets it get added to the trust every year. Once the legal right to recover that income expires because of the statute of limitations, she has made a taxable gift to the trust. So there are gift tax consequences if the income beneficiary doesn't enforce their right to get that income. Does that make sense? So it can become a tax. It can become a tax issue. So you definitely want to tell the trustee, hey, you should really catch up on these income distributions.
Great, thank you.
Ryan, you're up next.
Hey, Stephen.
How you doing?
Good. If I see non-dividend distributions on a 1099, how does the allocation work for that particular item between income and principal?
That's a great question. So on a corporate tax return, non-dividend distributions are reported on a separate form. I can't remember what the form is, but if you see that on a 1099 DIV, all that means is that it's a distribution to the shareholders in the regular course of business that is not corporate E&P. Okay, ordinary dividends is a distribution in the regular course of business that has eaten up the corporate earnings and profits. The non-dividend distribution is any distribution made to the shareholders in excess of that. Okay, that being said, that non-dividend distribution could be liquidating or it could be non-liquidating. And that's the key under the fiduciary accounting rules, is if it's a liquidating distribution. In other words, so what the UPIA says is, if you get a distribution from a corporation and they're telling you it's a liquidating distribution, that's principal. All other distributions are income. So if I look at the brokerage statement and the detail of that item and I can't tell one way or another, I would categorize it as income. Because unless I know it's liquidating, it's not principal. That's kind of how I would approach that.
Okay. Thank you.
Any other questions?
I don't see any other hands up.
Okay, so if there's no other questions, I guess we'll conclude the call. And as Stephen said, we'll be sending out the slide deck and then also a recording of the full webinar. And then just so everyone knows, we also share trust and estate related articles on our website. So if you're looking for more insights, you can check that out. Yeah. Thank you, everyone.
Thank you.
Thank you,
Thank you.
Stephen.
Good one.